Hello everyone. Welcome to Brilliant Bankers. In today's session, we'll be discussing about the AML KYC. What is AML KYC? AML KYC is a chapter or a lesson about anti-money laundering and the Know Your Customer base, which is a important exam in IIBF. So let's start off with money laundering. So what is money laundering? Money laundering is a process of converting illegally obtained money into clean money through various stages. The negative impacts of money laundering on individuals or businesses and societies are like money laundering damages the financial sector, institutions, which are critical for economic growth. They also promote crime and corruption that slow down the economic growth and reducing the efficiency in the real sector of the economy. Most global researchers focus on two major money laundering sectors, that is, drug trafficking and the terrorist organizations. The effect of successfully clearing the drug money is more obvious that there will be more drugs, more crime, and automatically more violence. The link between money laundering and terrorism can be a bit more complicated. For an obvious example, we can take that if terrorists is knocking down money so that the authorities cannot monitor them and prevent their planned attacks. So what is the major problem? Money laundering is a problem that is not only in the world's major financial markets and the sea centers, but also in the emerging markets as well. As emerging markets open up their economies and financial sectors, they become increasingly appropriate targets for the money laundering activities, wherein it creates unpredictable changes in money demand, as well as causes the large fluctuations in international capital flow and the exchange rate. So, this is the importance of why we should combat money laundering because of the drug issue and the terrorism funding. And coming to some historical concept, the earlier forms of money laundering activities were like that of smuggling and gambling, wherein money laundering techniques have evolved significantly, becoming more and more complex and harder to detect over this time. This sophistication can be attributed to several factors like the advancement in technology, the rise of digital finance, cryptocurrencies, and online banking, and introduce new ways to move illicit money globally, wherein cryptocurrency allows for anonymous transfers, often across borders, making it difficult to trace. You can take the globalization also. With increased global trade and financial integration, launderers exploit the international loopholes, utilizing the shell companies, the offshore accounts, and also complex international financial structures to obscure the origin of the funds. Professionalization. Criminal networks employ professionals like lawyers, accountants, and financial experts to create highly sophisticated laundering schemes, wherein these experts design intricate layers of transactions by mixing illicit funds with legitimate business activities. They also go for trade based laundering, wherein the criminals use legitimate trade transactions to launder money. This involves manipulating invoices, misrepresenting the quantity or quality of the goods, or also falsifying the shipping documents to move money through the global trade. The regulatory adaptation. As government strengthens anti-money laundering laws, that is the AML laws, criminals respond by developing more advanced techniques. By bypassing these regulations, they might use methods like structured transactions or layering of the funds through multiple institutions to avoid the deduction. And it also has come through the integration into legitimate economy also. The final step of money laundering, where the dirty money is reintroduced into legitimate economy, has also become more refined. Criminals invest in real estate, art, luxury goods, or even the legitimate businesses to disguise the sources of their funds. So, in response, the financial institutions and the government has ramped up the use of the artificial intelligence nowadays, the big data, and enhance their AML programs to counteract these sophisticated methods that are used by the launderers. However, the constant evolution of laundering tactics keeps the fight against financial crime as a continuous challenge. So, now let's discuss what are the stages of money laundering. The stages of money laundering. Before going into that, let's go into the legal definition of money laundering. It is to provide the official definition of money laundering according to the relevant regulations. All places have different meanings. As we had discussed in the earlier slide itself, what is money laundering? It is the process of converting illegally obtained money through clean and making it into a clean money. And the main three stages of money laundering are placement, layering, and integration. To discuss placement, it is introducing illegal funds into the financial system. That is just introducing the illegal funds. Layering, it is the complex transactions to obscure the sources of the funds. So, as you place the funds into the financial system, it is not to be traced or backtracked. So, they bring in a lot of complex transactions, that is, transferring from a single person to 100 persons and getting that money transferred back to another person. This becomes layering. And coming into integration, integrating clean money back into legitimate economy. When they are doing the integration process, it automatically becomes a clean money. The black money is converted into clean money. Coming to the techniques of money laundering. Manipulating trade transactions to disguise illegal funds and dividing large sums into smaller deposits to avoid deductions. They also break down the transactions into amounts below reporting the thresholds also. So, trade based laundering is manipulating the trade transactions to disguise illegal funds. Then comes the smurfing activity, wherein we divide large sums of money into smaller deposits. Whenever there is an amount that is being deposited above 5 lakh or 10 lakh, it is automatically being in a repeated interval, it is being intimated by the financial institutions to the Reserve Bank of India. So what they do is they divide the large sum into smaller deposits to avoid deduction. Then comes the structuring base, wherein breaking down transactions into amounts below the reporting thresholds. So what is the reporting threshold? The reporting threshold comes to 15 lakh, or normally it is said as a maximum of 15 lakh with a continuation of 5 lakh is also counted. So breaking down the transactions into the amounts below the reporting thresholds. This is called as structuring. Coming to shell companies, that is utilizing anonymous companies to conceal the ownership and the source of the funds so that no one knows from where the fund has originated. That is utilizing the anonymous companies or the offshore companies. And then comes the casinos and the high risk businesses, wherein exploiting cash intensive businesses to launder money. A lot of money laundering is done through casinos and drug dealing, and also for the purpose of terrorism. Now, coming to the impact on the banks. What does money laundering do to the banks? So, here we highlight the risk and the consequences of money laundering for the banks and the financial system. Where do they have the reputational loss, the financial loss, the regulatory sanctions on them, and the operational challenges. So how does that happen? It damages the bank's image and the trust they have with their customers. So where then their reputation is being lost. Potential fines and penalties are being sanctioned by the Reserve Bank of India. Again, they have a financial loss and a reputation loss, both from the Reserve Bank and also in front of the customer. They also lost operating licenses or restrictions on business activities. There is also increased cost and resource allocation for the compliance for all these risk or the loss that are being faced by the banks when it comes to the compliance of the laws that are being made. So what is structuring of money laundering? How do you explain structuring? So let's learn about the techniques in detail. Structuring, it is also can also be said as smurfing. What we said is smurfing is breaking down the amount into small bits. What is structuring? Breaking down the amount into those bits that is below the reporting thresholds. So structuring, also known as smurfing, is a common technique used in the money laundering to break down large sums of illicit money into smaller, less suspicious amounts. The goal of structuring is to avoid triggering the regulatory reporting requirements, such as those are mandated by the anti-money laundering laws, which often require financial institutions to report transactions above a certain threshold. So, what are the key aspects of structuring in money laundering? They break down large transactions. Instead of depositing or transferring a large amount of illegal funds, which could raise the red flags, the launderer divides the sum into smaller amounts, often just under the reporting threshold, and deposit them into different bank accounts or different financial institutions. They also use of multiple agents or accounts. Criminals often employ several individuals who are known as MRFs. These individuals who deal in money laundering or who are the persons who deposit the money in their account, they are called as MRFs. Several individuals known as MRFs or use multiple bank accounts to carry out these transactions. These people may deposit the money in different branches or even in different countries, making deduction by the financial institutions very more difficult. Coming to multiple transactions over time, instead of a single or a large transaction, structuring involves multiple smaller transactions over a prolonged period. This incremental approach makes it harder for the authorities to identify a pattern of suspicious behavior, wherein it is very difficult for any authority to find what is the amount coming and from where that amount is coming into a particular account. When hundreds of transactions are coming with a smaller amount of 1,000 or 2,000 rupees from different accounts, no one is going to barge into the account to have go for a check or anything of that sort. Coming by avoiding the suspicion, by breaking down the transactions, the money launderers aim to avoid the scrutiny of the AML systems that are designed to flag large or unusual transactions. This tactic helps them evade the deduction while moving illicit funds through the financial system. Digital structuring is also done. In the modern concepts, structuring has evolved to include the digital methods such as multiple small wire transactions or the cryptocurrency transactions and the use of online payment platforms that allow for frequent smaller transactions also across various accounts. So structuring is illegal in many jurisdictions because it is a deliberate attempt to circumvent the financial reportings and its regulations, and also it conceals the origin of the illicit funds. So financial organizations are totally required to monitor and report any suspicious activities that may indicate structuring, even if the individual transactions do not meet the reporting threshold. Coming to the next step of integration, that is integration in money laundering or integration of money laundering. Integration, we can say it is the final step. in money laundering after the process of placement and layering. So placement, you start layering. Whatever we learned in structuring is called layering. And it is a point at which the illicit funds are fully absorbed into the legitimate economy, making them appear to come from legal sources. By this stage, the money has already been laundered through various transactions, making it difficult for the authorities to trace its illegal origins. And the key features of integration process are like investment in legitimate assets. These money, the laundered money, is often invested in high value assets such as the real estate, the luxury goods, wherein we can call the art, the jewelry, or the cars, or shares in the businesses also. These assets can be bought or sold with relative ease, helping the launderers legitimize their money. By the use of the shell companies, money launderers set up shell companies or legal entities with little or no legitimate business activity at all, into which illicit funds are injected. These companies can then engage in normal financial transactions, such as buying property, paying salaries, or making investment, blending dirty money into the legitimate earnings also. They also involve in business ventures wherein criminals create or invest in seemingly legitimate businesses such as restaurants, hotels, or the retail operations. These business can mix illicit funds with the legitimate income, especially those that deal heavily in cash transactions. This method makes it hard to distinguish between the legal revenue and also the laundered money. They also carry out international transactions by transferring funds across the borders. They may seek jurisdiction with weaker regulatory oversight, wherein offshore banking, international business investments, or the cross border mergers are common methods used to integrate the laundered money into the system. Then comes the loan back schemes. In this method, the criminals place their illicit funds in an offshore entity and then has that entity loan the money back to themselves or their business. The launderer repays the loan with clean money, further obscuring the illicit origin of the money. So, loan is taken from a company that does not even exist, and then the loan is being repaid. So, this is a way called the loan back scheme. They also go through gambling and betting also, and also false invoicing. That is through trade based money laundering. Businesses involved in the cross border transactions may manipulate invoices under or over report the value of the goods and services, or even create false transactions. These fraudulent activities allow launderers to introduce legal money into the legitimate trade channels. What are the challenges in detecting the integration? Or how integration can make it difficult to trace the source of funds? At the integration stage, money is more difficult to detect because it has passed through numerous layers of transactions and it is now intermingled with the legitimate funds. The origin of the money is effectively disguised, making it appear as if it came from a lawful business activity or investment. To combat all these integration in money laundering, financial institutions and the regulatory bodies employ the monitoring systems, including the audits, the STRs, the suspicious transaction reports, and also the use of advanced analytics to spot unusual transaction patterns that happen across the borders and industries. However, as launderers continuously refine their methods, staying ahead of these remains a big challenge for the financial institution. Coming discussing about the preventive legislation, the international efforts have been taken to combat money laundering. Combating money laundering is a global priority on date, as the illicit flow of money across the borders poses threat to the integrity of the financial systems and also for national security. Over the years, international organizations, governments, and the regulatory bodies have developed frameworks and coordinated efforts to counter the money laundering and its related activities also, such as terrorist financing. And let's come to have an overview of the major international efforts that has been taken to combat money laundering. The first one is the FATF, the Financial Action Task Force. The Financial Action Task Force is the most prominent global organization that is dedicated to combating the money laundering, terrorist financing, and all other related threats. It was established in 1989, and FATF develops international standards and promotes effective implementation of legal, regulatory, and also the operational measures to combat the money laundering. Wherein FATF efforts also include 40 recommendations, which are globally recognized standards for fighting the money laundering and terrorist financing. They also provide a comprehensive framework for countries to develop policies that include like measuring the customer due diligence, the CDD, the suspicious activity reporting, the SAR or the STR as said in India, and the enhanced due diligence for high risk clients. So what are the main thing? It is a customer due diligence CDD, the EDD, which is the enhanced due diligence, and the suspicious transaction report, STR. Mutual evaluations. The FATF always conducts peer reviews of member countries, assessing how well they have implemented the AML measures. Also, the countries found non compliant may face sanctions. And in this case, the FATF not only counts it as AML measures, they also say it as AML CFT. It is counter finance terrorism, anti money laundering, and countering finance of terrorism measures. So, countries facing non compliant may face sanctions or be placed on a grey list or a blacklist, which affects their access to the international financial systems. And public listing is also done. FATF maintains a list of jurisdictions that have strategic deficiencies in their AML CFT. Countries on the grey list are subject to increased monitoring, while those on the blacklist face sanctions and also international isolation. United Nations has also played a significant role in the international efforts to combat money laundering through its various initiatives and treaties, particularly in the relation to organized crime and terrorism. Some of the efforts are like the UN Convention against the illicit traffic in narcotic drugs and the psychotherapeutic substances, the UN Convention against transnational organized crime, the UN Security Council resolutions, which have uh, which have been passed in 2001 and then also in 2019. The European Union has also a robust regulatory framework to combat the anti-money laundering and terrorist financing system. It approaches the guided by the directives that ensure member states comply with the international standards. Coming to the Basel Committee of Banking Supervision. Other than the Basel Committee, we also have the Egmont Group of Financial Intelligence Units also. The Egmont Group is an international network of financial intelligence units that facilitates cooperation and intelligence sharing among the other countries to combat money laundering and terrorist financing. These financial intelligence units are responsible for receiving, analyzing, and also reporting the suspicious transaction reports to the law enforcement agencies. The International Monetary Fund has also come forward for the same thing, and a group of banks, 13 global banks, which comes as the Wolfsburg Group. They are an association of 13 global banks that aim to develop frameworks and guidance for managing financial crimes that include money laundering. It plays an influential role in establishing industry best practices for banks and the financial institutions. Then comes the Asia Pacific group. The list keeps on going, wherein we have the G7 and the G20 also, which has played a role in promoting international cooperation on AML issues. Both groups have enforced the FATF, the Financial Action Task Force. So each and every banking group or the banking organization or any country automatically follows the FATF rules to adopt stronger AML measures. They also advocate for increased transparency in the financial system to prevent the misuse of offshore jurisdictions for the money laundering. Coming to the Basel Committee on Banking Supervisions, we will be discussing about the BCBS in a separate topic in the same video itself. Coming or discussing about international cooperation. So, what is the role of international cooperation here? Here we discuss about the importance of international collaboration in effectively combating the money laundering, sharing information and coordinating efforts between countries that significantly improves the effectiveness of AML initiatives. Since money laundering often involves the movement of illicit funds across borders, international cooperation is essential for traffic, detecting, and prosecuting the money launderers. Financial crimes can span multiple jurisdictions, making it difficult for a single country to effectively investigate or prevent money laundering without assistance from other nations. By coordinating their efforts and also by sharing intelligence, countries can close loopholes that criminals exploit and enhance the overall resilience of global financial system. Benefits of the international coordination in AML are like enhanced detection of cross-border activities, strengthening the compliance with the global standards, improve the identification of the beneficial owners, timely reporting, and enforcement also. It also brings in increased capacity to combat sophisticated laundering. And some of the examples of the successful international collaborations in AML are that is the Egmont Group of Financial Institutions. The Egmont Group is one of the most successful international corporate cooperation that was initiated for combating money laundering. It brings together the financial intelligence units from over 160 countries to exchange the financial institutions or the financial intelligence. What is it? It is the Egmont Group, EGMONT, Egmont Group of Financial Intelligence Units. This network has enhanced the global effort to tackle money laundering and also terrorism financing. Another success story in 2016, these FIUs from multiple countries collaborated to dismantle an international money laundering operation involving more than $30 million in illicit funds by sharing information about transactions that crossed the national borders. The Egmont Group was able to help authorities trace the flow of money back to the criminal organization that was involved in drug trafficking. The European Union also have a fourth and the fifth anti-money laundering directives. The European Union's AML directives promote cooperation and coordination among member states. The fourth AML directive, that was in 2015, required the establishment of centralized registers of beneficial owners, while in the fifth directive, they introduced enhanced cooperation among the FIUs, particularly concerning cross-border financial transactions. So one of their success stories in 2020 operation that was coordinated by the European police or the Europol. It involved 18 European countries working together to take down a network of 1,500 money mules. Who are these money mules? Money mules are the person who transact the money for another. They get a small commission. They transact. Let A be a money mule. He transacts the money for Mr. B. Mr. B is the master. He just distributes some money to A, C, D, and F, and they are the person who go and deposit in their bank accounts. And this operation was called EMA 6 and was successful because of the seamless sharing of financial intelligence and cooperation between the law enforcement agencies across the European Union. As a result, more than 400 arrests were made in this. The FATF styled organizations in different countries, wherein you get it in Bangladesh, the Philippines, and all places. The operation that was conducted as Trojan's Shield or a Green Light, which is a major international effort involving 17 countries. This involved the FBI and the Europol in 2021. It involved law enforcement agencies creating a fake encrypted messaging app which criminal networks use to communicate their illegal activities also. There are a few more joint initiatives by the US and other countries also. Coming to the Financial Action Task Force public listings. In this case, as we discussed about the gray and the blacklist, which is a direct result of international cooperation in AML efforts. Countries placed on these lists are subject to increased scrutiny and must take corrective actions to avoid the international sanctions. Some of the success stories in that case comes like countries like Pakistan and Sri Lanka having successfully implemented reforms to address money laundering risk after being placed on FATF's grey list in 2019. Till that date, there was 100% money laundering taking place in Pakistan and Sri Lanka. I am not claiming that it is completely over, but it has significantly reduced. Sri Lanka was removed from the grey list after it significantly strengthened its AML CFT regime in response to FATF evaluations. Pakistan is not still clear. And to conclude this, international collaboration and information sharing are critical components of effective AML efforts. Criminal organizations operate across the borders, utilizing the global financial system to launder money and also making it easy for countries to work together. Utilizing the global financial system to launder money, making it essential for the countries to work together. The initiatives like the Egmont Group, FATF, and the joint operations between the law enforcement agencies also demonstrate the power of the coordinated efforts. These partnerships not only improve the detection and enforcement, but also lead to strengthen global AML standards to better the regulations of the financial institutions and enhanced resilience of the financial systems to combat money laundering. So, with this, we will be ending this video. We will be starting off with the India against money laundering in the next class. Today's class was valuable. If you have any questions or doubts on this lecture, you may put it up in the comment section. Please do like, share, and subscribe the channel, The Brilliant Bangers. This is Nishan signing off. Jai Hind.